I get over $5,000 a month from dividends. In this video, I'll explain what dividends are, why I bought and hold my dividend investments, and I'll end with what I think most investors should do. I'm Peter. I worked as an analyst on Wall Street, and I was VP of Investor Relations at Activision Blizzard and Electronic Arts. I'm not giving financial advice as I don't know you or your situation, but I'm hoping you'll find my experience useful. There's a lot of misinformation, both online and from the financial industry, which is why I'm trying to give unbiased information. I hope you'll like and subscribe to my channel. So what's a dividend? Dividends are cash payments to shareholders. Dividends and stock price appreciation are the two main ways companies return capital to investors. Dividends don't pay investors extra money. The day after a dividend is paid, the stock price usually falls by the amount of the dividend. For example, Altria paid a 94-cent dividend on June 13th. The stock closed at $45.76 that day. The next day, June 14th, it opened at $44.90. That's 86 cents lower, about the same value as the dividend. Now, there's always things that swing the value of a stock, news, interest rates, but basically you see that the dividend came out of the stock price. So dividends don't matter, right? Actually, they do. Dividends provide about 40% of the total long-term return of the stock market. Dividend payments are also, for investors, taxed differently depending on how long you hold the stock. If you hold a stock for a short time, like less than 60 days, and you receive a dividend, it'll be treated as ordinary income. But if you hold the stock for longer and get the dividend, it may be treated as capital gains and taxed at a lower rate. This is a bit complicated, so Google for more, but you can see that dividends are an important part of the money typical investors receive from their stock investments. Now let's look at my dividend investments. My biggest dividend paying holding is the S&P 500 Index Fund. It currently has a dividend yield of 1.7%. That means for every $100 I have in the index, I get $1.70 per year as dividends. Now the index has yielded as low as 1% and as high as 6%. 1.7% is on the low end of that range, which might mean that the index is a bit overvalued. But I'm holding the index now because one, I don't time the market, and two, I believe that the S&P 500 is the best long-term investment most people can make in the stock market.
So I think it's a policy that'll get a good result and is likely to stick.
Back in 2001, the top 5 companies in the S&P 500 were GE, Microsoft, Exxon, and Pfizer, and Citigroup. Only one of those, Microsoft, is among the largest today. So that means many of the biggest investments in the index have failed, and yet at the same time, from that period, the S&P 500 returned to investors an average of 7.3% per year, which is really pretty good considering the turnover of the largest holdings in the index. I don't know the future of any specific company or anything really. No one does. But I do believe the United States will remain very business friendly and that the S&P 500 will find and hold the largest, most successful American companies, which is why I'm holding it. Tobacco stocks. Tobacco is an area that pays a lot of dividends and one that I've overinvested in. Now, the big tobacco companies, Altria, Philip Morris, and British American Tobacco, pay 5 to 7% dividends, which is 4 to 5 times higher than the S&P 500. They're doing this because investors are concerned about falling numbers of adult smokers and litigation risk. And that's pushed down the price of those stocks and pushed up the payout ratios. Now, it's always risky to bet against the market, but I'm doing so here for the following reason. One, the number of adult smokers is falling by about half a percentage point per year and has done so for a long time. And the price of cigarettes is rising and continues to rise. And that means business remains very good. I expect that to continue. Also, these companies are moving away from cigarettes, which definitely cause cancer, towards vaping, which is less harmful, they say. It is working, and I believe they're going to continue to deliver nicotine and that people are going to continue to use them for a long time. Altria makes Marlboro. It has a market cap of $79 billion. And in the past 5 years, it paid out $30 billion in dividends. I expect they will continue to pay out $30 billion in dividends over the next 5 years and probably the next 5 years after that. I don't see the world changing so rapidly in the next few years, but I could be wrong. But that's why I'm holding Altria. And British American Tobacco and Philip Morris have very similar trends. They're international companies. They don't really do much business in the United States. I expect them to follow the same path and to perform similarly. But I think they have less legal risk as well. Verizon is a high dividend paying stock that hasn't performed well for me. I bought it in the mid 50s. It's now in the mid 30s. During that time, they've increased the dividend, which has gone from a 5% yield to a 7% yield, but it's been a very poor investment for me. Now, I admit I bought this company because I heard Warren Buffett bought it, and I thought, well, if Warren's got it, it's probably good enough for me, and it was obviously a mistake for him and for me.
I don't get excited because other people get excited about things.
The lesson here is individual stocks are risky, even if Warren Buffett has bought it. I should have done more thinking on my own. And if any of you have ideas about what to do here with Verizon, please let me know in the comments. I'm kind of at a loss, literally. Oil Services, Enterprise Products Partners, EPD, is a company that operates pipelines throughout the United States. It moves oil and hydrofluorocarbons around, does it very efficiently. It's very hard to make a new oil pipeline. The regulatory pressure is enormous, so they kind of have some pricing power. And the company is a third owned by the management team, so their incentives are aligned with the shareholders, which is very important. I bought the stock in the 20s. It's up 30% since then, and it's paying a 7% dividend. I'm a very happy investor here. I'm concerned about climate change, but I don't think oil and plastics are going away anytime soon, so I think this is a keeper. Finally, we have Apple. Apple is the world's most valuable company. It has, I think, a $3 trillion market cap. It also pays the most dividends of any company in the world by a long way, but the dividend yield is very low. Apple pays 0.5% as dividends. So for every $100 you have in Apple, you get 50 cents a year in dividends. So it's not a great dividend payer for individuals, but it's a very important aspect of Apple's stock. By paying a dividend, Apple attracts more investors. There's a lot of investors who only can buy dividend stocks. Those are institutional investors who must own stocks that pay dividends. They can own Apple. That pushes the price up. Apple actually spends about 4 times more on buybacks than they do on dividends. I'm pretty happy overall with my Apple. It's performed very well for me and for most people. The company, as I think most people know, is tremendously successful. iPhone, iPad, App Store, Watch, AirPods, all huge businesses. The risks to Apple, I believe, are that regulators might disrupt the App Store and that eventually every leading technology company has its moment and then things change. Now, Apple just introduced Vision Pro headset, the first product you look through, not at, from Apple. I think it's going to be a winner. I think Apple's going to remain the leading tech company in the world, and I'm very happy with my investment there. Should you invest in dividend stocks or specifically target dividend stocks as part of your investment strategy? Generally, no, I don't think so. Individual stocks are very risky. You can see it's hard for me. It's hard for Warren Buffett to always get it right. And it's risky to pick individual sectors and regions of the world. People should be generally highly diversified. Most professional money managers and individual investors underperform index funds, which is why for most people the strategy should be pay down high interest rate debt, establish an emergency fund, and then steadily invest in a diversified index fund or ETF like the S&P 500, the Vanguard Total Market Fund, something like that. And then be patient. Over time, you're very likely to outperform your peers and have a good outcome. But by over time, I mean over many, many years. So those are my dividend investments. If you're interested in learning more and getting started, I have a video that ranks beginner investment books, from the bad ones to the good ones, and I think will help you get started. Check it out. Thanks and goodbye.